Hello, welcome to my YouTube channel. This channel is all about the insurance. Today we will discuss the insurance scores. In the previous video, we will discuss about the credit scoring. Insurance scores are confidential ranking based on candidates' information. They are a measure of how a person manages his or her financial affairs. People who manage their finance will tend to also manage other important aspects of their lives responsibility such as driving a car, combined with factors such as geographical area, previous crashes, age, and gender. Insurance scores enable auto insurers to price more accurately so that the people less likely to file a claim pay less for the insurance than people who are more likely to file a claim. For homeowners insurance, insurers use other factors combined with the credit such as a home's construction, location, and proximity to water supplies for fighting fires. Insurance scores predict the average claim behavior of a group of people with essentially the same credit history. A good score is typically above 760 and a bad score is below 600. People with low insurance scores and tend to file more claims, but there is an expectations. Within that group, there may be individuals who have stellar driving records and have never filed a claim, just as there are teenager drivers who have never had a crash. All the teenagers as a group have more accidents than people in other age groups. Credit report information once it is becoming increasingly important to have an acceptable credit records, whether we like it or not. Society equates the ability to manage the credit responsibly with the responsible behavior, even if individuals have a bad credit records through no fault of their own. Landlords often look at applicants' credit records before renting apartments to see whether they manage their finance responsibly and are therefore likely to pay their rent on time. Banks and other lenders look at the credit records of the loan applicants to find out whether they are likely to have loans repaid. Some employers also look at credit records, especially where employees handle money and view a good credit records as a measure of maturity and stability. And some insurance companies and underwriters have long used credit records in case where additional information was needed. Before the development of automated scoring system, underwriters would look at the data and make decisions. Often, overly cautious side that disadvantage many more people. Automated insurance scoring and underwriting systems eliminate the weakness and inherent in someone's personal judgment and have allowed more drivers to be placed in preferred and standard rating classifications, saving them money. With the development of these scoring models, the use of credit-related information in underwriting and rating for many insurers has become routine. Insurers use insurance scores to be different extent and in different ways. Most use them to screen new applicants for insurance and price new business. Insurers need it. Insurers need to be able to assess the risk of loss, the possibility that a driver or homeowner will have an accident, and file a claim in order to decide whether to insure that individual and what rate to set for the coverage, provided the more accurate the information, the closer insurance company can come to making appropriate decisions. Where information is insufficient, applicant for insurance may be placed in the wrong risk classification. That means that some good drives will pay more than they should for coverage and some bad drives will pay less than they should. The insurance company will probably collect enough premiums between the two groups to pay claims and expenses, but the good drivers will be subsidizing the bad. By law, in every state, insurers are prohibited from setting rates that unfairly discriminates against any individuals, but the underwriting rating processes are geared specifically to differentiate good risks from the bad risks. Since insurance is a business, insurer favors that those applicants that are least likely to suffer loss. One of the key competitive aspects of the personal insurance business is the ability to segment the risk and the price policies accurately according to likely cost of the claims generated by those policies. Insurance scores helps insurers accomplish these objectives. Thanks for visiting our YouTube channel. Please support us and subscribe our channel for further notification. No, we will meet tomorrow. Stay blessed.